Welcome to Everyday Explained, where we break down the systems people interact with every day and show you how to use them with confidence. Today we're examining a document millions of people receive every month, but few actually read carefully. The credit card statement. In this episode, we'll walk through how a statement is structured, how interest is calculated, how to verify charges, and how to spot early warning signs of billing errors or fraud. By the end, you'll know exactly what each section means and how to use that information to protect your money. A credit card statement is essentially a monthly financial report summarizing how your account was used during a billing cycle. It lists purchases, payments, interest charges, fees, and your remaining balance. Many people glance only at the minimum payment and total due. That habit can quietly cost hundreds of dollars per year in interest and missed corrections. Start with the statement summary section, usually at the top of the page. Here you will see the previous balance, payments made, new purchases, fees, interest charges, and the new balance. This section quickly tells the story of your account activity for the month. If the balance seems higher than expected, this is the first place to begin investigating. Next, locate the billing cycle dates. These show the exact period the statement covers, often around 28 to 31 days. Transactions made after the closing date will appear on the next statement instead. Understanding this timing helps you predict when purchases will be reported and when interest might begin accumulating. The payment due date is one of the most important lines on the entire statement. Paying at least the minimum by this date prevents late fees and protects your credit score. However, paying only the minimum keeps most of the balance active, meaning interest will continue building on the remaining amount. Many statements also show a minimum payment warning box. Regulations in several countries require card issuers to display how long it would take to repay the balance if only minimum payments are made. For example, a $2,000 balance at typical interest rates could take several years to eliminate with minimum payments alone. Now review the transaction list. Every purchase, refund, and fee should appear in chronological order with the date, merchant name, and amount. This section is where many people discover errors. Take a moment to scan it carefully. Even small, unfamiliar charges deserve attention, especially if they repeat monthly. If a charge looks unfamiliar, verify it before assuming fraud. Some merchants use parent company billing names rather than storefront names. Searching the merchant name online or checking your receipts often resolves confusion quickly. If the charge still appears incorrect, contact the card issuer promptly. Statements usually include a section labeled interest charges or finance charges. This area shows how much interest accumulated during the billing cycle. The number can be surprisingly high if a balance is carried month to month. Reviewing this figure regularly helps reveal the real cost of borrowing. Interest is calculated using the annual percentage rate, commonly called the APR. Although the rate is quoted yearly, it is applied daily to the balance. A typical card with a 20% APR effectively charges interest every single day that a balance remains unpaid. Many statements display the average daily balance used to compute interest. This number represents the average amount owed throughout the billing cycle. If large purchases remain unpaid for many days, the average rises, increasing the interest charged at the end of the cycle. Look for the fees section next. This area may include late payment fees, cash advance fees, or foreign transaction fees. These charges often appear quietly among regular transactions. Identifying them early allows you to adjust habits that may be triggering avoidable costs. A useful habit is to compare the statement balance with your own spending records. Many people track purchases through banking apps or budgeting tools. When the numbers match, confidence increases. When they differ, the statement provides the official ledger used by the card issuer. Your statement will also show available credit and the total credit limit. These numbers indicate how much borrowing capacity remains on the card. Approaching the limit too closely can temporarily lower credit scores, because high utilization signals potential financial strain to lenders. A practical guideline used by many financial advisors is to keep credit utilization below 30% of the card's limit. For example, a card with a $5,000 limit ideally carries no more than $1,500 before payment is made. Staying below this threshold helps maintain healthier credit profiles. Statements also include reward summaries. If the card offers cashback or travel points, these sections track rewards earned during the billing cycle. Reviewing them ensures purchases are credited properly and helps you decide whether the card's reward structure actually benefits your spending habits. Some statements contain year-to-date spending totals by categories such as groceries, travel, or dining. These summaries can quietly function as a budgeting tool. If one category appears larger than expected, it may signal an opportunity to adjust spending before habits compound. Another practical check is reviewing automatic recurring charges. Subscriptions for streaming services, software, or memberships often renew without notice. A credit card statement is one of the easiest ways to see which subscriptions remain active and whether they are still worth keeping. If you ever find a genuine error, credit card protections typically allow disputes within a specific time frame, often around 60 days after the statement date. Reporting quickly gives the issuer time to investigate, while temporarily removing the disputed charge from your balance. Reading your statement monthly transforms it from passive paperwork into a financial control tool. You begin to see patterns in spending, interest costs, and recurring charges. Over time, this awareness reduces surprises and strengthens everyday financial decision-making. Thank you for spending this time with Everyday Explained. A credit card statement may appear routine, but it contains critical information about borrowing costs, spending habits, and potential errors. When you review it carefully each month, you replace guesswork with clear financial awareness. The final principle is simple: read the report that tracks your money. Before your next payment, take 5 minutes to open the statement and review 3 items: the balance summary, the transaction list, and the interest charged. This quick routine catches mistakes early and helps you understand how your spending decisions affect the next month's bill. If you make this review a consistent habit, the statement becomes more than a bill. It becomes a monthly diagnostic report for your financial behavior. That small shift, from ignoring the document to actively reading it, can quietly improve long-term financial stability.